exclusive basis. Okay, so you're not when you go and get a quote, or when you get a quote, or your contract price for your grapes is all GST exclusive, and when you go to a contractor, he'll quote you GST exclusive, but you've got to add the GST on top of that. So when you're doing your budget, which is just income and expenses will total you, everything is exclusive. But however, when we start doing our cash flow, we're going to have to account for the GST just to help with to know, or it'll become clear when you actually see it on there. But you know, in the initial years, if you're doing a lot of development expenses, you're actually going to be getting GST back for the year, or back for the period that you do. But it affects the cash flow, or it affects the or you balance your loan, or you balance at the bottom there. So we have to factor GST in the actual cash flow, but not in the actual budget. Okay. So we'll just do just make sure you note that.
Everyone knows what GST is. It's not a stupid question.
Yep. Yeah.
Government sales tax.
Yep. General sales tax.
General sales.
Yeah.
Put on top of everything you buy or any service that you contract in, whatever the base price is, they'll have at the moment 15% on top.
The way I sort of explain it, and I don't know if this makes sense to you, is kind of when you're in business, you're a collector of GST, and you pay GST. So when you get your grapes, and say you get $100, you sell something, whoever buys it pays you $100 plus the GST, so he pays you $115. So you've collected $15 on behalf of the government. Now all your deductible expenses, or your cost of production to generate that $100 is $50. You've paid GST on all this goods or supplies that you've used to generate that $100. So what's 15% on 150 is what?
$7.50. $7.50.
So 50. So that's $7.50. So at the end of your GST period, which is normally 2 months for a business, or can be monthly, you've collected $15 on behalf of the government, but you've paid out $7.50. So what you pay to the government, or to the IRD at the end of that period is $7.50. Okay, is that a good way of explaining it? So you're collecting the GST, and then you're claiming off what you've spent or you've paid GST on to get a net figure.
You're not double taxing yourself.
No, you're not. No, it's just a transactional or consumption tax. Yeah.
The danger comes when you get a big payment at the end of the season for your grapes. That big payment includes 15% of GST. Now, in terms of your cash flow, it's, hey, great, a huge amount of money comes through your account and can ease your cash flow.
Yeah.
2 months later, you've got to pay that 15% to the government, and it can have huge impacts on cash flow.
So that's why we need to, when we do the cash flow part of it, we need to allow for the GST as well.
As I always said to one of my old bosses who I used to work for, never assume it's your money. You're just looking after it for the government. You know, don't count it in your cash flow. Don't assume that you've got it to spend, because you haven't.
Yeah. Yeah, I mean, this is giving all those things here. It's just what headings you've got. So when you do your income, don't just put in, we won't just put in 120,000 for grape sales. How many hectares was it of, variety, what the yields were and what the price was per tonne? Well, you'll have to work that out in your budget. So yeah, again, that's another schedule that you'll have to do. Okay. And then there are all the normal costs there, which we've covered this. Now, we've assumed that you're borrowing X amount to do the development, but also during the year you're going to be paying, you're going to need an overdraft facility, because we're assuming that all the cash you have has gone into buying the land. So the cash flow will work out how high your overdraft gets for the year. And then after year one, you might capitalise that and put that onto a term loan. So what you could do is the bank could give you 200,000 all up, and you could just whittle that away and just spend it as you need it, or you might say, well, give us a $200,000 limit, and because as soon as you draw that money down from the bank, you're paying interest on the whole lot, and you might not be using it all at once, or you won't be. So what the best probably way of structuring it is that you just have an overdraft limit, and you see it, and you use that for the year, and then you work out, and then you might just put that onto a term. But I'll explain that in the next session a bit more there. Leasing, we're not assuming we're not leasing anything. Taxation, we're just leaving out at this stage. Drawings, we've covered that. As I say, once you've done your first year, it's going to be a lot easier going forward. But really, we're not, as I said, it's going to take you 4 to 5 years before you get to a status quo situation. So we've actually in the interim got to do some development budgets, and I'll cover that probably in the next session. So this is what we call about the cash flow. So the cash flow is, you've got all those expenses there for the year, which we had, or you had from that monitoring report, and then it's a matter of just July, June, July, August, September. It's just spreading that income or that expenses out over that time to work out what sort of overdraft requirement you're going to need, or seasonal facility is what I call it normally. So as I said, if you do that cash flow, it might help you work out, well, I shouldn't draw all that money down because straight away and pay interest on it because I'm not going to use it. I'm going to be in credit for a lot of the time. I might as well just have a smaller limit and then draw it down further down the track. So it just helps you with planning there. So that's what that's saying there. Convert some of that seasonal finance to medium or long-term debt, because the interest rate's going to be a lot cheaper. But again, we'll cover that in the finance and the preparing an application to the bank section. We don't need to do anything of that. So that gross margins, that was quite a good point that John put on before. If you were looking at putting in different varieties or going, for a high premium regime or just a volume regime, you do some gross margins, and that's basically just working out the total revenue for one system less the direct costs. So it's all the cost of production. It's not your rates and insurance and all that. So that's what we call a gross margin. And you break it normally down on a per hectare basis, and I think we have an example here. It's in those notes, but you can see here they've just worked on going premium. Oh, that's actually a great one there, actually, but that was quite a while ago, so excuse these notes. I haven't updated them, but there's your gross margin per hectare as opposed to growing bulk grapes. So that's an example there. Sensitivity analysis will come to once you've got your budget up and running, or your status quo budget, and that's just looking at how does it affect the bottom line. So on that there, he's based it on 9.9 tonnes at 2,150 a tonne. So what happens if the price goes down to there, and I only do 8.9 tonnes per hectare? What's falling out the bottom? So it's 10,000 there as opposed to 14 there. So that's what we call a sensitivity analysis. And again, that's the beauty of spreadsheets. You can do all that sort of stuff.
That's going to be very important for this exercise, is comparing gross margins, because if you're not sure about whether to do premium or bulk, looking at the difference between the two, once you've got all those costs together, because it is the operating cost, it is the production cost that's going to vary between premium and bulk. Okay, all your overheads are going to be the same. It's those operating production costs. Okay, and it's that that's going to, when you see effectively the bottom line, we call it that because when you add everything up and take everything away, that gross margin, that margin you're left with, some of you may look at it and go, oh, okay, not what I thought. All right, so that's a very important
we're going to leave it there because we're sort of talking about development stuff, and what I'll have before next lecture is we'll have the cash flow template sorted out for you, okay? And then we'll just talk a bit about the years 1 to 3 and how you set that up. Okay?
Cool.
So we'll leave it there.
Thanks, Paul.
Oh, if you have any questions, I think you can contact me on that EIT online thing, can't you? But I'll just give you my details, eh?
Will you use, will you be able to do Wednesday next week? You'll struggle to do the afternoon.
Yeah, Wednesdays, yeah.
Okay, what we might do, I'll have to have a chat with Tim, see how he's fixed for next Wednesday, but I'm sure there'll be questions that you have. You go away and start thinking about this, both you guys and the online guys. We'll use Wednesday next week as a session to give you the opportunity to fire those questions at me, and I'll do my best to answer questions around the information that Paul's talking about. Okay, so go away, have a think about it, digest what you've heard. Contact Paul direct if you want to. Those details are online as well. Otherwise, next Wednesday afternoon.
Is that HB? Paul Evans?
Yeah, HB's at Hawke's Bay. Yeah. John, as I say, my timetable is, mornings, between 9 and 12, any time during the week is fine.